Hello and welcome to the third installment of Hot Coffee, Hot Topics. We're super happy to be here talking with you all today. And I have our partner, Bill Urbanik, here with me. And there is no shortage of things to discuss. It is a pretty emotional time.
That it is, Bree, and thanks for having me today, and thanks for tuning in, everybody, and watching. It is an emotional time. Stock market has had a rough year in 2022. Politics, midterm elections are at the height of everyone's feelings these days. Shortages of things on the shelves that we'd all like to buy, inflationary gas prices, cost of going out to eat has gone up significantly. Cost of eating at home has gone up significantly. So life's a lot different for people these days than it was just a short time ago. And when those things affect people's bottom line in their households and how they run their households, emotions definitely go up.
You've been an advisor for 20 years. Have you witnessed any changes in client behavior with regards to stock market performance?
I have, Bree, and thanks for mentioning the 20 years thing. That is something that's kind of hard to believe hearing it out loud. Times like this make it seem a little longer, but overall, it's hard to believe it's been 20 years. Yes, there are changes in clients' behavior and investors' behavior from the time I got into this business in 2002 to now, in 2022. I think people react a lot more quickly to the day-to-day, week-to-week, month-to-month volatility and market changes and news cycles, things like that.
What would you attribute the change to?
Access to information. I think when you look at the single biggest change from 2002 to now is, when I first got into this business, people would get their statements quarterly, so every 3 months they'd look at their account, and a lot of things could happen in that 3-month period. They might have been down 5-10% at one time, but by the time they got their statement, they were recovered mostly, or even positive, maybe up by then. Where now people get monthly statements, they have online access, they're looking at things daily, maybe even sometimes multiple times a day. They have apps on their phone that they can easily access account information. They've got news alerts, notifications from other apps saying stock market this, stock market that, this stock this stock that. And I think it's the access to information and the constant flow of that information through to them that has just heightened their emotions quite a bit.
Yeah. Do you feel like we should place blame on that development, or is that...
I don't know. Well, that's a good question, because I do believe there is some blame to go around, but I think access to information is not a bad thing.
Right.
I think access to information is good. I think access to information increases engagement. People know more of what's going on. I think those are positive things. What I don't like to see is people overreacting to certain situations, and allowing emotions to overtake their better decision-making powers that they have if they are a little less emotional. As far as blame goes, I do place blame in a few areas. I think that the media in general tends to be very negative, and feed on people's desire for, or I don't even want to say desire, but maybe just aptitude to tune in more when news is negative. Negative news is good for ratings.
Right.
And ratings, positive ratings are good for profits and bottom line. And these are for-profit corporations. And so they have a financial benefit, a financial incentive to create the feelings that get them better ratings. And unfortunately, that's negativity. That is making people afraid or more angry, or just generally getting them fired up in a negative way. Now, with that being said, I think there is blame to be placed on the viewer, where people just believe everything they see on TV and only watch one station. I think that the consumer, the viewer, needs to take more responsibility in understanding that news isn't 100% news anymore. A lot of it's entertainment. And that they need to make sure that they're getting information from a credible source before reacting to it. So I place blame in those two areas, and unfortunately, I spend a lot of my time with people addressing these issues.
We are a week out exactly from the midterm elections, and I haven't even turned on my TV the last couple days because the last time it was on, it was a ton of this person's awful because that person's awful because. Do you see, when we're coming up into these heightened political moments, a correlation between investor behavior and political beliefs?
Well, it's interesting that you bring up, absolutely, but it's interesting you bring up the commercials. Because, now so many commercials are negative commercials about someone's opponent as opposed to positive commercials about
your own.
The candidate.
Right.
And again, that feeds into the negative sentiment. All right. Why run a positive commercial about how great I am when people probably won't watch it as much as if I run a commercial about how bad the other person is? And I think that's very unfortunate and sad and something that needs to be looked at in campaign finance rules. But that's for another day. But there is definitely a correlation between investor behavior and political beliefs. There is statistically some that suggest that Democrats on average tend to invest less in stocks than Republicans. I don't know that I've seen that in my career, but there is data out there that says that a investor that leans left to moderate will have less stocks in their portfolio than one that leans right. But I don't know that I could really point that out as being something that I've seen as an obvious discrepancy between the two.
Can you give our viewers an example of a time when a client was reacting emotionally to a situation based on politics, and that reaction, didn't impact their decision making, but would have maybe gone poorly had it?
Well, I've got a few, but one always stands out in mind. It actually involved two investors. It was 2016. It was a very heated election year between Hillary Clinton and Donald Trump. We all remember it. It was unlike any other election we had witnessed. Sure. Okay. Unfortunately, it's becoming a little bit the norm now, but that was the first one that was really like this. And the Thursday before Election Day, I got a call from an investor it was a guy who at 11:30 a.m. who said, basically, Bill, I'd like you to take all my money out of the market, put it in a money market, because if that Donald Trump gets elected, the world's going to go to hell and I'm going to lose all my money. And, we talked through it, and a little bit, I'll come back to that. But at 1:30 that same day, a lady calls and she says, Bill, I'd like you to take my money out of the stock market and put it in a money market, because if that Hillary Clinton gets elected, I'm going to lose all my money. And I mean, I laughed out loud, like as just a reaction. I kind of laughed, and she's like, why are you laughing? And I said, well, I just had the very similar call. And she said, well, see, I'm not the only one. And I said, well, actually, the other call was worried that if Donald got elected, that they were going to lose everything. And you're calling with the same fear, but Hillary. The different reason for that fear being that it's Hillary that you're worried about. Mm-hmm. And there was just silence on the phone. Mm-hmm. And she's like, well, that's interesting. I said, you could say that. And we talked through it, and with both people, I talked through, the policies that, the candidate Donald Trump was talking about, and the policies that candidate Hillary Clinton was talking about. And we also discussed the policies of the current administration, President Barack Obama. And we talked about all those things, and we talked about, historical statistics and trends, and they, got them to reapply some logic to their decision making, and, tamper down the emotions. And neither one made that decision that they ultimately called to do, thankfully, because the next few years after that were quite, we saw substantial growth.
Right. Mm-hmm. going into elections, how much does your and Tony and Jess's portfolio management change based on who is president or who is suspected to be president?
Well, that's a good question. I think most portfolio managers would suggest that a majority of their portfolio doesn't change as far as stock bond ratio. That's more, depending on a client's risk tolerance. I think there will be different sector weightings based on who's president. You may have a president that is leaning more towards clean energy, or a president that's leaning more towards, fossil fuel area and stuff like that. So you may have more weight towards certain sectors than others. Mm-hmm. But overall, as far as whether to be in stocks or bonds or anything else, that doesn't change that much. And I think any portfolio manager would say the same. It's just going to be maybe slight, 20% of the portfolio may weight different and weight more or less in sectors versus others.
Okay. The question on everyone's mind, Democrat versus Republican. Who is better for the stock market? If I had a quarter for every time I was asked that question, I probably wouldn't be here. I could retire. But there's a lot of statistics you could find on this, and unfortunately, I think some of it, I could sit here and say this party, and then someone sitting across from me who disagrees would find a pretty valid reason to bring up why that statistic is not good. Mm-hmm. Such as if I said, well, this party's had a better average return than this party, the person sitting across from me could say, well, that's because, when this person was president, they had the other party as in power in Congress, and they stonewalled everything they wanted to do. Mm-hmm. So it's very difficult to look at it fairly, mm-hmm. except in one instance where you said, okay, let's put Democratic Party in control of the White House, Senate, and House, and the Republican Party in control of the Senate, White House, and House. Okay, so all right, the average annual return of those two parties during full control, 14.52 from 1923 to 2019, 14.52 for Democrats and 14.52 for Republicans. I mean, do you get any more down the line? I mean, right. It's literally down to like tenths of a percent mm-hmm. difference. Mm-hmm. Okay, when one party's in full control versus when the other party's in full control. And I think that's the only way you could fairly look at it. Because I think you could argue that we wanted to do some things, but the other side didn't want us to do it, and so forth. But when you're in full control, you can't really point fingers at anyone else but yourself. And the average returns are right down the middle. I'll give you another statistic. The best performing president of all time with the stock market, Calvin Coolidge, a Republican, averaged 26% during his term a year. The worst performing president of all time, Herbert Hoover, a Republican, averaged 30% negative every year. Sure.
So, a lot of it is timing and circumstance, where a president came to office. If you came to office after a recession and got started with a recovery, mm-hmm. your numbers look good, mm-hmm. And you may not have really done anything, so that's why I like to look at it from the perspective of when someone was in full control versus other. The other, so that's good for that question, I think.
Okay. Are there any historical trends in market performance as it relates to politics that you're seeing playing out today?
Yes, there are a few that I think that are interesting. One as it relates to the 4-year cycle of a president. When you look at every year of a 4-year cycle, statistically, the first and the second year are pretty close, with that second year being the worst of the 4. Mm. That third year, historically, way outperforms the other 3 years by a very large margin. And I'm talking like first year is around 6 to 7% return. The second year is between 5 and 6%. That third year is over 16%. Oh, wow. And then again, that fourth year is down around that 6 to 7% range, which is, close to the other two. But that third year is significant. And, a lot of research has suggested The reason that is a sitting president usually loses seats of his own party in Congress during the midterm elections. Sometimes control of Congress changes hands during that time, and you have checks and balances in DC, which suggests that markets maybe like that better than one party being in full control, because you can have, if one party's in full control, you can have extreme shifts in policy where markets tend to like things to be a little bit more predictable. And you know, when there's gridlock in Washington, you can kind of predict that not a lot of things are going to get done, especially anything too far to one side or the other. You know, so that is a big thing playing out today. Is I think you are seeing the second year as the worst year in this administration's, and I hope this continues to play out where we see the third year being a very strong year, and I'm hopeful that it will be. But you never know. You know, past performance, you know, the standard line is past performance doesn't guarantee future results, and that's true.
Right.
But I will say that, you know, if you look at you know, going back to that time frame I discussed, third year in the presidency has not yet lost money in the market, whereas the first and second years have only been positive 59% of the time. Both years were positive. And here we are, of a good first year, 28%. I think the S&P was up in the first year, down right now, still time left in this year. But overall, this 2-year period, the market's still positive, but not both years have been positive. Where 59% of the time that's been the case, you know, where, you know, 82% of the time the market has been up in the second half. So that's a big difference. That's a big difference. And like I said, that third year is a huge deal. I mean, I'm talking the third year of a presidency. The lowest return was 16%, which was JFK Lyndon Johnson's third year. Okay, 16%. That was the worst third year of a cycle. The other third years ranged between 30 and 70%. So it's significant. But again, you know, that really only tells us, that maybe only really gives us hope and optimism for what's coming. It doesn't guarantee us anything.
Sure. Outside of looking to the past to, you know, figure out what to hold on to as we navigate through the moment toward the future, do you have any other advice for investors as they try to manage their emotions amidst all of the chaos?
Well, I have a statement that emotions have no place for decision making with regards to finance. It has no place. I tell people all the time, save your emotions for your family and friends and the causes you care about, and save your brains and your guts for business, financials, you know, investing, because that's where that needs to be. I've always said that if there's two things people get really emotional about, and they'll throw logic completely out the window, the most educated, intelligent people, logic gone, reason gone, education gone, because of emotion, it's when they're dealing with their kids and their money. So if someone's dealing with something with their kids and their money, you've got to expect the most intelligent, educated person could be completely irrational. All right? But I'll add a third leg to that stool now. It's not just kids and money now, it's politics too.
Yeah.
And when somebody is talking politics or they are fired up because of politics, I am seeing the most educated, intelligent people just completely throw logic and reason out the window like they would if it was their kids. And it's our job to really, you know, reapply that reason, the logic, the research, the statistics, and get them to see the road through the fog. And they're human. We all are. We all get emotional. So my advice is to try to remember, you know, it's okay to get emotional. It's not so much okay to act emotional. So if at any time you're feeling emotional and you feel those emotions getting the best of you, you really need to call your advisor, or, you know, if you work with us, call us, and we'll walk you through it, and we'll get you to reapply, you know, the things you should be applying to the situation so that you can make a reasonable decision for not just the present, but your future too.
That's great advice. I think that is all that we're going to have time to cover today. Great talk, lots of things to cover. If you're our client and you're viewing this and you want to further the conversation, or you're feeling like you need a stabilizer type of consultation here in the office, please give us a call and set up a review. We can talk about your portfolio. Bill, Tony, and Jess are really great at kind of being that stabilizing force, no matter what is coming down the pipeline out in the world there. So thank you for chatting with us today,
Thanks
Bill.
for having me again.
We will look forward to seeing you at our next Hot Coffee, Hot Topics. If you have any questions or topics that you'd like to hear us discuss here on the show, you can email me at Bree, that's Bree with 2 E's, at shcwealthmanagement.com. You can also find our contact information on the website. Search for us on Google. We're right at the top of the list there. And thank you for being with us.
Thank you.